Yeah, I was waiting for the recording to start, but now that it has started, let's dive straight into what we have for today: disposal of subsidiary. So when we talk about the disposal of a subsidiary, it occurs where the parent company lose their controlling interest in the subsidiary, where the parent company lose their controlling interest in the subsidiary. So it is usually when they sell their interest in the subsidiary. It is usually where what's it called? Usually where the parent company decide to sell part of their interest in the subsidiary. However, we have two types of subsidiary. Two types. Let me say we have two types of disposal, or let me say we have three forms. Disposal can take three forms. Basically, we have full disposal and partial disposal. Full disposal is where the parent company has maybe 90% in an entity and they sold the whole 90%. Fine. That's a full disposal. The parent company has 30% in an entity. They have 60% in an entity and they sold the entire 60%. That's full disposal. But partial disposal is where, sorry, 1 minute.
I cannot hear you. Okay.
Okay, so partial disposal is where the parent company holds maybe 70%. They now sold 30% out of it to retain 40%, or they sold 50% out of it to retain 20%. So what do we mean? When we have a full disposal, there will be no retained interest in the subsidiary at all. Like they will not have anything in the subsidiary again. But when we have partial disposal, they will still retain either an associate or an ordinary investment in the subsidiary. They will still retain either a, a, an ordinary investment holding or an associate holding in the subsidiary. 1 minute, please.
I cannot hear you.
Okay, sorry for that break in transmission. So that's for full disposal and partial disposal. The other one that is somehow closer to it that we take to be disposal also is where there is disposal of subsidiary, but control is still retained. But where that is the case, there is disposal of the subsidiary, but control is still retained. We don't really call it disposal, rather we just call it a transaction between owners of equity. You know, under step acquisition, where the parent entity has already gained control, they now acquire additional interest. We say it is what? We don't recalculate goodwill, we don't recalculate this thing. Rather, what we just do is to do adjustment between holders of controlling interest, right? So the same thing is applicable here. The same thing is applicable in the case of disposal, where you dispose and you are still retaining control. We just treat it as transactions between holders of equity interest. Now, where we have where we have full disposal, you will consolidate. I mean, for the SOPL now, you will consolidate up to the date of the disposal. That is, if disposal occur middle of the year or ending of the year, then you have to consolidate to the date of disposal. But after that period, you don't consolidate again because they don't have control again. But in the statement of financial position, you will not be consolidating the subsidiary because it has been disposed. Then what you will only be showing is the group gain or loss on the disposal of the subsidiary company. The group gain or loss on the disposal of the subsidiary company. So then the cash received on the disposal is also added to their cash or bank balance. Cash or bank balance. Yeah. So that is that. Yes. And that gain or loss, the group gain or loss on the disposal will also be shown in the statement of profit or loss afterwards, after deriving the profit before after the profit before tax. So after you get your PBT, you bring the gain or loss on disposal, you bring your tax element, and then you get your profit after, and then you get your profit after tax. Now, calculating the gain or loss on disposal, calculating the gain or loss on disposal is of two ways. When we are preparing the separate financial statement of the parent, we calculate what is the gain or loss to the parent only. And that one will be, we do what? The we do the disposal proceed less the cost or the carrying amount, of the investment. Then we also less any previously recognized um, increase in the what's it called? Any previously recognized increase in the on the what's it called? On the investment. So take for instance now, you bought the shares for 2 million, and as at the time before you sold it, you were fair valuing it through profit or loss, or fair valuing it through OCI. You were fair valuing it through OCI, sorry. So whatever amount of profit you've recognized, whatever amount of gain or loss you have recognized, you have to take it out to determine what is the actual gain or loss to the parent company as a separate entity. But that one is not really our major concern. Our major concern is profit or loss to the group. And the way we do that is following this schedule. We take the fair value of the consideration they receive, that is the disposal proceeds. We add it to the fair value of the investment or share retained. Where it is a full disposal, that one will be zero because they are not retaining any investment. So that gives us the total sales consideration. Then we now less the parent portion of the net asset at the date of disposal. And what will be the parent portion. It will be the subsidiary net asset at the date of disposal. We have the goodwill that is not there impaired. No, goodwill is not part of their net asset. Then we less what? We less NCI. We less NCI value. That is what NCI has of the net asset we are calculating on that day. Then the difference is what will give us what is the profit or the loss on the disposal group. And how do we treat this? The profit or the loss on the disposal group is added to our consolidated retained earnings. So you know the double entry would have been debit cash or bank with the whole proceed. Then credit retained earnings, consolidated retained earnings with the profit or loss on the disposal group. And do what? And credit the investment that you are selling. Credit the investment you are selling so that you can take it out from the books. From the books. Yeah. So so where the disposed subsidiary is seen as a discontinued operation. I want to believe you guys have done non-current assets held for sale and discontinued operation. That's IFRS 5. So what do you do? The reports, the income and expenses of the subsidiary will not be treated as will not be consolidated. Rather, it will be shown separately as what? It will be shown separately as the report of the discontinued operation. It will be shown separately as discontinued operation. Now, where so as I was saying, where there is partial disposal, but what they retain is ordinary investment. Where there is partial disposal, but what they retain is ordinary investment, then like just like we said, we will not be consolidating anything in the statement of financial position. However, that investment that they retain now, because it's now ordinary investment, to be one of those things we'll be showing as a line item in the consolidated statement of financial position. It is one of those things we'll be consolidating, we will be showing in our consolidated statement of financial position. While in the statement of profit or loss, is only the group gain or loss will be showing in the listing. And if there's any dividend received after the date of disposal, you know, if they were still control, you cannot recognize dividend. But when there is no longer control, you go back to recognizing your dividend. So, but where there is retention of significant influence, the only thing is that the investment retained will now be treated as an associate using what? Equity method. It will be treated as an associate using what? Equity method. That's just the only difference. But where there is retention of control, like I said, it's just transfer between the equity holders. It's just transfer between the equity holders. And in that case, you still consolidate like before. Just that when you are sharing profit, you have to be careful because the profit sharing ratio before the disposal and the profit sharing ratio after the disposal will be two different things. Okay, so what do we have? Let's look at few questions and we call it a time. Question one, who is reading? Yeah, people on this call.
Yes, sir. Question one.
Yes, sir, we are here, sir.
Required. Calculate the profit. Question 1. Required. Calculate the profit or loss on disposal. Milk PLC had acquired 80% investment in Tea PLC several years ago. Milk PLC disposed the entire investment for $80 million on 1st March 2007. The group policy measures non-controlling at fair value acquisition, and goodwill has not impaired since acquisition. The details of the disposal are as follows: cost of investment, fair value of T's net asset at acquisition, fair value of non-controlling interest at acquisition, T's PLC net asset at disposal. All figures assumed to be correct. Required. Calculate the profit or loss on disposal.
Okay. So we have Milk PLC that has 80% investment and they dispose of the entire 80%. That is a what? That is a full disposal. I don't know. The devil is actually trying his possible best to make sure this class doesn't hold. I'm feeling very, very sleepy.
I don't feel sleepy. Oh.
Okay. We have
Sir, we cannot hear you.
I'm not talking yet.
Oh,
I don't know. It
okay,
seems
okay.
seems my pen is acting up this night.
Sir, sorry. Take care. Oh. Sir, have you eaten?
Yeah, by God's grace, I've eaten. Don't know why everything is just doing anyhow. I think it's even the food that is making me feel sleepy. All right. So Milk PLC, we have them daily. So calculation of profit or loss to the parents only. We'll have disposal proceeds. Something is wrong. So we have sales proceeds. They said the net asset at disposal, no. Net asset at acquisition, no. It told us here that they sold it for how much? They sold it for 80 million. That's the sales proceed. What's wrong with this thing this night? Why are you doing like this? 800 80 million with less cost of investment, 56,000, and that will give us how much? Figure.
24 million.
That's the profit or loss to the parent only. But if we are to calculate, I don't know, my pen is misbehaving this night too. So what do we have? We'll say sales proceed. Sales proceed is how much? 80 million. Then fair value of investment retained. And what will be the fair value of investment retained? It will be nil. Less milk share of net assets. So we'll have what? Net assets net assets at date of disposal. It gave us the net assets reward 72,000. So since they did not give us goodwill, they said goodwill has not impaired since acquisition, but they did not give us the value of goodwill. That means we have to calculate the goodwill ourselves. And goodwill will just be what? Yeah. So to calculate the goodwill, we'll say goodwill. So for goodwill, we will have what? Purchase consideration, 56,000. NCI, NCI at acquisition is 15,000. Less net assets at acquisition. Hi, this pen is making things difficult this night. So shall will not cancel this class because of this thing now. Less net assets of So we have what? Share value. I don't know what's wrong with my board this night. So we say less share value of net assets. And that's how much? Fair value of net asset at acquisition is 58,000. So that means goodwill at acquisition is how much? Is 13,000. And since they told us the goodwill is yet to be impaired, that means you need to bring it here and say goodwill. Unimpaired goodwill or 28 million more. Then after that, we now less subsidiary, which is less NCI.
Please, I have a question.
Go on.
Why do we put goodwill as 28 when we calculated 30?
Ah, mama dá mi lóhùn. Èmi máa ti ń rí nǹkan mi mà ní. Is this pen that is affecting me? I might have to cancel the class because what this pen is doing, I cannot use it to solve proper questions. Unless, what's it called? Whoever, NCI share of net assets. So what will be the NCI share of net assets? NCI will have what on that day? Ọlọ́run ò ṣàánú ọmọ ẹ̀ o. Ah, so to calculate the NCI, we have value at acquisition. Value at acquisition is how much? 15,000. Then share of post acquisition. Their share of post acquisition will be we have net asset at date of disposal to be 72,000, and we have net asset at date of acquisition to be 58,000. Okay, so what do we have? 52,000 minus what? Minus 58,000. And that will give us how much? Because if you remember, majorly, what used to be the difference between our net asset at date of consolidation and date of acquisition is the retained earnings. That's why we are taking the difference between those two net assets to be retained earnings, because they did not tell us there was a change in their capital structure. What will this give us?
14,000.
14,000.
But don't forget, we have to do what? They only hold 20% of the company, abi? Because the other party hold 80%. So 20% of that 14,000 will give us what?
That's 2,800.
That should be true, abi? Then
Yes.
if we come back to 17,800, what do we now have as the, what do we have?
So how is this 17,800?
How did we get it? Okay,
Yes.
Mama.
Oh. Okay. 67,200.
57,200.
67,200. Times 6, not 5. 67,200.
Total.
Twelve thousand eight hundred.
12,800.
So that is that. Sincerely, I would have loved to do more, but the way this pen is doing is really, really disturbing. You can see how my writing is scattered all over the place. I don't know why it's doing like that. Or let me try and close the sheet and reopen it if it will work. Hello. Ladies and gentlemen, something is wrong. I don't know. You even close the file now. Now what?